Hi everyone, this is Aki with another tax mistakes video in our series of going over some typical tax mistakes, and we're going to go over 9 tax mistakes that have to do with deduction and credits inaccuracies. So I'm just going to go over and show you the typical ones quickly, and then we will talk about each in more detail. Number 1 is claiming credits and deductions incorrectly, claiming credits you shouldn't have, or missing credits that you may qualify for. Number 2 is claiming expired provisions. So these are tax provisions, tax laws that basically expired. You may have been claiming them, or maybe something actually was extended and you forgot to amend to claim them. Number 3 is not claiming earned income tax credit. About 20% of taxpayers who qualify for this credit, very valuable credit, actually don't claim it. So we will go over some of the reasons why and how to avoid that. Number 4 is missing education credits and deductions. That's another big one that sometimes people don't realize, that let's say they have a loan on paying for college and so on, they can also deduct this or use it as a credit to claim a credit. Number 5 is not reconciling Form 1095A, which is basically if you have healthcare coverage to Obamacare or marketplace insurance, and you do have to put that on your tax return, otherwise it can be rejected and so on. Number 6 is not claiming recovery rebate credit, which many people don't know what it is, but basically for 2020 and 2021 tax returns, if you didn't receive the stimulus payment, you could claim it as a credit if you didn't receive it but qualified, of course. Number 7 is not repaying first-time homebuyer credit, which many people in 2008, 2010, when we had some of the financial crisis going on, people got credit if they bought their first home. However, there was a condition of having to repay some of this credit over years, so some people just forget about that. Number 8, not claiming exception to the 10% penalty if you take out money from your retirement funds. And there are actually some exceptions that some people are not aware that they can claim, so they don't get the penalty on their tax return. And finally, number 9 is missing out on home sale exclusion, which is up to $250,000 on the gain from selling your primary home per taxpayer. So we will go over each of them in detail. Just want to kind of give you a heads up what we're going to be talking about so you can decide which section would apply to you. Number 1, claiming credits and deduction incorrectly. So a lot of this stuff that we're talking about is actually in an article that I have on my website, which goes over the 10 typical tax mistakes and in detail the subcategories for each. So the ones we're discussing right now is number 5, and this one has 9 different deduction credit inaccuracies. And this website has actually links to a lot of these items that you can review if something applies to you. But you want to be careful if you're claiming credit and deduction you shouldn't have. You want to double check that you should. Like on IRS website, there's a list of different credits and deduction that you can claim, and I'll put the link in the show notes. And basically it has all these credits that you can find more information about and so on. And it may also be like an idea to review it, to give you an idea that maybe, oh, there's a credit for this, I didn't know that, to kind of remind you that maybe you should qualify for something. Many people don't claim certain credits. Now, if you're not sure, because some of this information may be a little overwhelming, and if you're not sure if you understand it correctly, IRS also has these interactive assistants, interactive tax assistants, which are basically like tools, question and answer, based on question and answer. So you can click on them, and I'll put the link in the notes as well. And it has a section on deductions and credit. And if you're not sure if you qualify for certain credit, you can just click on it. Let's say you want to check if you qualify for education credit. Basically, you click begin and you provide some information. So I ask you, your age, your filing status, if you have dependents, what's your income, blah, blah, blah. And based on that, it will tell you whether you should be able to claim this credit. Now, so this is really helpful because you can figure it out quickly. Let's say you do claim credits, but actually let me just also go back here, or if you do claim credits but you shouldn't have, you can be banned from 2 to 10 years. And some of the credits that often are banned are the earned income tax credit, child tax credit, additional child tax credit, credit for other dependents, and American Opportunity Tax credit. And if if let's say you claimed it, you got a refund, later on, if IRS reviews your tax return and disagrees, they might want to take back your refund and, in addition, ban you for 2 to 10 years. Now, after 2 years, let's say if you made that mistake, there was a mistake, and now, you still should be able to claim the credit now. Currently, let's say it's after 2 years, you could try to claim it back for the current tax year by filling Form 8862. And by filing that form, you can try to get some of these credits that were banned for you and reclaim them for the current year. So basically that form is just asking your information and asking which credits were banned for you, why, how did you claim it, and then the current situation to evaluate whether or not you can claim it in the current year. And so if that was the case, make sure you fill out this form, because if you were banned but in this current year you want to still claim the credit, just respond and provide the information they're asking for to see if you qualify for the credit. Now let's also talk about the fact that it can be the other way around. You might qualify for a bunch of credits, but you don't claim them. And that's another thing. People, especially if they're filing themselves, they don't understand their situation, or, the tax preparer didn't mention something that possibly could qualify them for, and so on. So there could be many reasons why, but you could miss tax deduction credits. And some of the most often missed ones are like contribution to traditional IRAs, child independent tax care tax credit, student loan interest deduction, earned income tax credit, which I'll mention in my video, but it's about 20% of people who qualify for this credit don't claim it. Losses from investment, qualified business income deduction, QBI for self-employed taxpayers, and startup costs. So some of these deduction credits taxpayer missed. And in addition, right now, after the 2017 tax law change, about 87% of taxpayers claim standard deduction because it's easier. You don't have to prove anything. You don't have to bring your receipts for charity deduction, medical expenses, and all that. However, there's still some percentage of taxpayers that could benefit from itemizing the deductions. And I'm just showing one simple example here. There's some limitations on state and local income taxes and so on right now. However, maybe if you're single and you have a high mortgage and you're paying property taxes and you have some medical expenses that you paid out of pocket, you might qualify. Sometimes it's hard to beat for married filing jointly taxpayers, the $25,100, which was the deduction for 2021. But for single, it might be easily beat when you have like I mentioned, high mortgage that you paid and high income taxes and some additional medical expenses, and you didn't make that much money. So it's worth your check if you're doing your taxes to double check, hey, let me just quickly add that up and see if it would benefit me to itemize. However, you do want to have records if you want to itemize. The number 2 mistake is claiming expired provision. Specifically, it has to do with the tax law change in 2017, the Tax Cut and Jobs Act that changed removed a lot of provisions from tax code, starting with tax year 2018, and certain things were no longer deductible, like let's say personal exemptions were now reduced to 0, safe deposit boxes couldn't be deducted, state local taxes were kept at $10,000, hobby expenses were eliminated from deduction, attorney legal fees, donations to college in exchange for athletic event seats, and so on. And basically what happens, sometimes taxpayers forget that they can't deduct certain things, especially if they're preparing themselves or they haven't prepared for a few years, they didn't have to file, and then they're refiling, they don't check that. And that's why it's good to double check on some of this information. And additionally, another thing that happens a lot is basically there's some provisions that Congress keeps renewing, so it's only creating confusion. For example, the tuition and fees deduction, it was enacted in 2002, and every year it was not every year, but many years it was expiring. So it was expiring that year for tax, let's say 2019, and guess what, mid-March or late February, Congress extended them. So some people who didn't deduct or didn't use the deduction in the beginning of the season now would have to amend. And sometimes it didn't make financial sense to go back and amend, and some people lost on these. The same with the mortgage insurance premium, and another one that had been expiring for a while, and then it was extended again to 2021. So some people already missed on the deduction early in the season, and then they didn't go back to amend to claim it because it's not usually a big number, but it's still your money. So some of these things, be aware that tax law changes from year to year, so you want to double check, make sure that you're using the most recent tax law and everything applies. Now, let's say if you are missing some of these provisions that were extended, what you can do, you can amend up to 3 years. And if financially maybe it doesn't make sense, there are many free places that you can do and file for the amendment. VITA, which is the IRS program, and another one, AARP, has a program that helps taxpayers file tax returns. So you might look into maybe doing a free program that you can file and claim some of this money that you missed out on, basically. The third mistake, and this one is probably the biggest one from our list, is not claiming earned income tax credit if you qualify for it. And about 20% of taxpayers who qualify for the credit actually don't claim it. We're talking about 5 million potentially eligible taxpayers who leave money on the table, and that's about $7 billion in unclaimed money, which after 3 years, if you don't file and claim it, guess what? It goes to Treasury. So, 66% of the 20% that do qualify but don't claim it don't do it because they don't have filing requirements. So they feel like, okay, I don't have to file, so I don't have to worry about it. Yes, and maybe they don't feel comfortable. Maybe, they don't feel comfortable preparing themselves, or maybe financially it doesn't make sense for them to go to a paid tax preparer. There are options to filing for free, like VITA programs, ARP program that does for seniors, and there's many city programs in many areas. And I'll put a link in the show notes where you can find out if there are any free options for you, which they can help you file it. Now, if you didn't do it last year, but you also qualify, you can do it up to 3 years. After that time, that money goes to Treasury. So it's loss for you. Now, even if you don't need to file tax return, you may want to for certain things, for certain reason. For example, you might receive some withholding. If you had some withholdings, that's the way to get them back. Claim valuable refundable credits, which earned income tax credit is a refundable credit. So that means you can receive it even if you have zero tax liability. You can protect your tax identity, because if you don't file a few years, you don't know if your Social Security has been exposed. So sometimes just filing for that reason is also very important to making sure that you are filing for yourself. No one is going to be taking advantage and stealing your identity. And start the statute of limitation. If you don't file, those tax returns can be edited for whatever years, because for a very long time, because the statute of limitation starts when you actually file. So that's an exposure for you as well. And you can receive other benefits and loans. You can use the tax return for maybe some city benefits, federal benefits, and so on. So you might want to do that for that reason. And the list of people who don't file and why. Many of them are non-filers, like we mentioned, about 66%. Some of them live in rural areas. They may be self-employed, taxpayers with disability, without children. They're not aware that they actually can still claim earned income tax credit even if they don't have dependents, grandparents raising children, and so on. And about 34% also miss on that credit because it's very complex. IRS website, there's some information, and you can actually use this interactive assistant to help you figure out if you can claim the credit. Now, the basic requirement, it can be kind of complex, and there are some rules that change, so you want to double check from year to year what they are. But you can't claim this credit if you're married filing separately. You must have earned income. That means you must have some kind of income. You go to a job. It's not just passive income. It's not just investment income. Must be U.S. citizen and so on. And so you can double check, some of the requirements in qualification. But for many people, they're just leaving it on a table. So that's a lot of people that are missing on this credit. And, for Tax Policy Center, it has an article here also about, people who are not claiming and they're missing on the credit. So it's very important for you to double check. If you do claim the credit and you shouldn't, like I mentioned in the previous point, it can be banned. You can be banned from claiming the credit up to 10 years, and after 2 years you could file a form 8862 and basically try to claim it again. But don't be afraid to claim it. If you qualify, you should claim it, and try to use the free resources if it's financially not feasible for you to go to paid preparers or do it yourself, maybe because you don't feel comfortable. So that's definitely the main point I would think from this whole video, is to make sure to double check that you can claim the earned income tax credit. The fourth one is missing education credits and deductions. And I'll put a link to the Tax Benefit for Education publication 970 that has more detailed information on each of the credits. Can be overwhelming, so let's go over briefly about some of the things that you can do without reading this whole publication. You can use the interactive tax assistant on IRS website that will help you figure out if you can claim education credit. Now, the main two credits right now that for 2021 and most likely for 2022 are the American Opportunity Tax Credit and Lifetime Learning Credit. And I have a video about them in more detail that you can watch, and I put a link right there. But basically, the main difference is that American Opportunity Tax Credit, it's a little bit larger and has a refundable part. So that means that for 2021, it was up to $1,000. It could be received even if you have zero tax liability. But it's a credit that you have to be careful when you're claiming if you don't qualify, because you can be banned from claiming it. Now, most education credits, like these two, as well as there was a couple of other ones, but I'm not going to confuse you to list them right now, have income limits. So like when you look at here, there's some income limits for taxpayers. So upper middle income families many times can't claim these credits, so it's really unfortunate. It can be claimed if you're married filing separately, and it covers only certain tuition fees, books, and such, computers, but not like room and board and so on. So the expenses that you can claim have to cover these specific educational costs, and has to be claimed by someone who's not a dependent, so whoever also paid for them. So if you have a student who's your dependent, they wouldn't be able to claim it, but you as a parent would be able to claim it. And there's also student loan deduction, which is another deduction. People sometimes not aware. They receive a Form 1098E, and they have some student loan deduction. They can put it on their tax return to claim that benefit as well. So it's just very important to check on that if you're paying any kind of education expenses, to double check if you can claim any of the credits. There's a lot of criteria, like I mentioned here, and it may look overwhelming, but it's just really question and answer, especially if you're using a software or if you go to tax preparer. It's just some criteria that you might have to use to double check. Like AOTC, you can only claim for 4 years versus the LLC, you can claim unlimited number of years. However, for example, AOTC is per student. So if you have 2 children, you can claim the credit twice on your tax return versus the LLC can be claimed once. However, you can add that the expenses for both of the students. If you have loans, sometimes people feel like, oh, I have a loan. Yeah, loan that you have to repay. That means those expenses are paid for you. You're being on the hook for these expenses, so you can claim a credit. So double check if you qualify, if you have any education expenses. That's a trigger for you to double check that you can claim education credits or deductions.